The market breaks a 5-minute low. You believe it's a market structure shift. You look for the retest, you put a sell limit, the market hits that limit. The market starts to go down just a little bit before it completely runs your stop. And then you're left wondering why this didn't work. Now, after 8 years of trading and hundreds of thousands of dollars made in the markets, the most misunderstood concept is market structure. And in this video, I'm going to be breaking down the market structure secrets that I've personally used to make hundreds of thousands of dollars and help thousands of traders achieve their first payouts. Now, not only will you learn how to properly use these market structure tricks, but you'll also learn on when to avoid specific trades that are low probability, which will help you lose less and make more money. Now, let's go ahead and let's get straight into it. Market structure has been one of the most important concepts in trading. It's the roadmap every single trader needs in order to understand the most important part as a trader, which is where the market will go to next. Now, let me ask you this question. How many times have you gotten into a trade that looked just like this, only to get stopped out just like that? Now, in this video, not only am I going to show you how to avoid losing trades like this, but I'm going to show you how to properly use market structure plus fair value gaps to identify the highest probability chance of finding winning trades. Now, by the end of this video, you will be able to properly identify market structure. You will also learn how to use market structure and something called fair value gaps to consistently make profits. You will learn how to avoid losing trades with defined rules. And you will use market structure to be able to get precise entries, but not only entries, exits as well. But first, if you want to see me break down examples of this market structure strategy and more, make sure to join my free community as well as subscribe to my second channel where I break down the markets in real time, because learning this is one thing, but seeing it in real time before the fact is another. Both of those links will be in the description below. Now, step number 1, we're going to identify phases of structure. Now, the market has 3 different phases. We have the trending phase, we have the reversal, and we have consolidation. That's it. The market is either going to be trending, the market is either going to be in a state of reversal, or the market is going to be consolidation. And in this video, we're going to be breaking down all 3 environments as well as the proper trading strategies to use in each single market condition. And we're going to start off by identifying our trend. Now, we're going to start off by talking about bullish trends and bearish trends. Now, everything labeled in here, you can reference in here as well. But essentially for a bullish trend, we're looking for the market to create something called a higher low. So on a retracement, we're looking for this market to have a higher low compared to the one to the left of it. Once that is formed, we're typically looking for the market to break the high and make a new high. Again, the market comes back down. This low is higher than the prior low to it. Once that low is formed, we're looking for the market to make a higher high, and this is going to be the basis of our bullish trend. For a bearish trend, we have the market make a move lower. We then have a retracement higher. The market then makes a high that forms that's lower to the one to the left, and then we ultimately break down and we make a lower low. This is going to be our bearish trend where the market consistently makes lower highs and lower lows. Now, this is going to be very important as basics, but we're going to build on this foundation in just a bit. Now, it's very important to understand how can we anticipate that higher low point and the lower high point. Simply put, the swing that's being created from swing low to swing high, we're going to look for the market to retrace about 50% of that range and below to look for a potential buy. Then again, once the market breaks a new high on a closing basis, we are then again going to look for the market to trade back down below 50%. So then we could look for potential entries, and then we're going to look for the market to have that next leg higher. Again, same thing on the bearish side. When the market has a leg lower, we're going to look for a retracement above the 50%. And then we're going to look for a potential lower high that forms. And then we're going to look to target that new low for the market to break back down. And again, we're going to continue on this type of path inside of these overall trending markets. Now, this is something that most people will not talk to you about market structure, and it's very important to know. Now, this is what I like to call the first potential resistance. Typically, when the market drops down into the 50% and a potential higher low forms, what sometimes happens, especially on the higher time frame, is there's going to be some sort of resistance that forms in here, whether it's an order block or whether it's a fair value gap. And I'm going to show you guys examples of this in just a bit. The market drops down into this level, it forms a low, and as we push up to a new high, we sometimes have to be aware of this specific point in here, and this is going to be very important for us to know because this will help us manage our trade accordingly. Again, same thing, sometimes the market will have a push up, we're above the 50%, we reject a key level in here, and then the market heads lower. However, again, sometimes there's going to be an area of support that's present in here that we might have to be mindful of, because if we find any entries on somewhere in here or any entries here on the buy side, we have to understand once the market hits that area, there might be some sort of reaction. So we have to be aware of that for our trade management, but more on that in just a bit. Now, we're going to talk about what makes an impulse swing valid. And it's going to be two simple criteria. Number one, a fair value gap must be present. And rule number two, we must have a close above the prior high in a bullish example and a close below the prior low in a bearish example. So here are two examples that we have printed on the chart. So we have this clear bullish impulse where the market has this swing low, we have a push up, and we have a high that forms. On the bearish side, we have this swing high that forms, the market breaks down, and then we start to form a low. So this is going to be our bearish swing, and this is going to be our bullish swing. Now, based off the two criteria, is this impulse going to be valid? And the answer is yes. So number one, do we have a fair value gap that's present? And yes, we do. So fair value gap is this area in here, in between candle 1, candle 2, and candle 3. Candle 3's low and candle 1's high. We have this area where the market has never retested. This is going to be known as our fair value gap. Similarly, on the bearish side, we have candle 1, candle 2, and then candle 3. And in between candle 1's low and candle 3's high, we have this area that has not been retested. Again, this is going to be our fair value gap. Now, within this impulse, criteria number two, do we have a close above the prior high for this bullish example? And yes, we do. We have a very strong bullish candle that closes above the prior swing high. Inversely, we have a strong bearish close on this candle below this low in here. So this is going to be a valid impulse that we're looking for to make your swing highs and your swing lows that much more highly probable. Now, this is going to be very important because we are going to be able to distinguish good impulse legs versus bad impulse legs by simply having these two filters. Now that we know what makes a really good impulse leg, let's get even deeper. So, identifying our market structure. So, we're typically going to have two impulse legs that we need to focus on. So, we're going to have the blue, which is going to be our higher time frame, and we're going to have the red, which is going to represent our lower time frame. So, let's just, for the sake of argument, we're going to say that this is going to be our 4-hour time frame, and the lower time frame where we're going to look for entries, we're essentially going to be using the 15-minute time frame. Now, we have this swing low, we have this swing high. And again, as we said earlier, we're going to typically look for the market to have a retracement down to the 50% mark. Now, this is where most traders get messed up, and this is why most traders get stopped when they see a bearish market structure shift on, let's just say, a 15-minute time frame, just like the example that we talked about at the beginning of this video. What most people don't realize is where they are relative to the higher time frame. So for example, if you're looking for a bearish market structure shift somewhere in here, and the market is sitting at a very strong 4-hour support level, you are looking for a very low probability chance that the market is going to keep heading lower because we're sitting at a support. You're essentially shorting at support versus a bullish market structure shift somewhere in here off of a support level with the higher time frame. Let me explain this further. On the way down, typically on the lower time frame for the 15-minute, we're going to have the market making lower lows and lower highs in here. The moment the market goes below the 50%, and let's just say we have a fair value gap that's present in here or some sort of area of support, the market will then typically have some sort of shift. And that's where we're going to look for our impulse confirmation, where the market has a swing low, a swing high, and we have a close above this prior swing. Then if there's any fair value gap that's present, that is going to be our confirmation that this is going to be our strong structural leg. Then we're going to look to see if the market can continue making higher highs and higher lows. And if we start to shift on the 15-minute, we know on the higher time frame, which is going to be our 4-hour, that this is going to be the likely target. Now remember, sometimes we're also going to have an area of resistance that's going to be present, which could then be our first objective. Now, similarly, on the bearish side, if we have a higher time frame, which is going to be represented in red, we know we have this bearish swing on, let's just say, again, this is going to be our 4-hour time frame. And let's say the lower time frame in this example is going to be our 15-minute. Now stay with me because I'm going to show you guys, depending on the type of trader you are, if you're a scalper, swing trader, or an intraday trader, what time frame pairings are going to be best for you in the next slide. But let's just go over this example real quick. So on the bearish side, if we're looking for a potential, let's just say sell in here because there's some sort of resistance, right? And let's say the 50% is right around there. The moment the market starts to head higher, we're making higher highs and higher lows on the lower time frame. However, the moment the market starts to hit this area, any continuation longs is going to be low probability because we're hitting a resistance point. What we typically want, again, is wait for some sort of bearish shift in here where the market forms a high, we break beneath a low and we get a market structure shift. And again, close below this low as well as some sort of fair value gap. Now we can start to look for the market on this lower time frame to start heading lower and for the market to make a lower high in here down to a lower low. And then we start to look for, again, continuation, lower lows and lower highs down into this lower low on the 4-hour time frame. That's the key. You want to make sure that these two time frames are in alignment. So if we're looking for a 4-hour bearish leg, we want to wait for the market to, again, go above the 50% mark and start to show bearish rejections and bearish reactions on this specific time frames. Now, if you're wondering what time frames pairings work best, I'm about to show you that right now. Now, here I have a very simple chart that's outlined where we're going to have our bias time frame and we're going to have our confirmation time frame. So the bias time frame is going to simply be the weekly time frame. We're going to pair that up with either the daily or the 4-hour. So again, if you have a bullish swing on the weekly time frame and you're someone who's more so a swing trader, you're going to want to wait for bullish structure on the daily or the 4-hour. If you're more, so this is going to be more for our swing traders in here. Now, if you're more of an intraday trader, like let's say you want to just look for intraday moves, day trader, then you'll look for the daily time frame and then you look for a confirmation on the 4-hour. You're going to look for a 4-hour impulse and then you're going to look for H1 or M15 confirmation. Now this is going to depend on the severity of the impulse. So if the 4-hour leg is very long, I'm going to typically look for the H1. If it's a small 4-hour leg, then 15-minute is fine. So this is ultimately going to depend on how big this impulse leg is. Now, if you're someone who wants to scalp, and there's a lot of you guys that do want to scalp, you can then look for 1-hour swings and then you can couple that up with the 5-minute or the 1-minute. And to be fair with this, you can find multiple impulse legs that you can trade across the day if you're looking for quick in and out scalps. Now let's go ahead, let's get into TradingView and let's break down a few examples in the marketplace. So let's go ahead and let's break down market structure on a real life example. So here we have a very clear impulse swing where the market forms a swing low to a swing high. Now, again, based off our criteria, does it break above with a closing basis? Yes, we close right there and we have multiple fair value gaps. So this validates our impulse leg. So now what we're going to do is this is going to be our high time frame. So we're going to draw the fib from our swing low to our swing high. And if you aren't familiar, this is going to be the fib setting that is going to be present. So 0, 0.5, and the 1. And this is going to be the settings that I have to plot this out. Now, once the market goes below the 50% of the range, that's typically where we're going to look for buys on the lower time frame. So we know that our higher time frame right now is going to be inside of a bullish swing. We're inside a potential support. So now we're going to go down to the lower time frame to look for a shift on the way down. And then we're also going to map out our higher high, which is right there. And we're also going to map out this area, which is going to be our first resistance zone, because we have a fair value gap and we have a prior consolidation before the move down, which is going to serve as our resistance area. So let's go ahead and let's go down to lower time frame. We have our higher time frame levels marked, and let's go ahead and let's see what happens on the lower time frame. So now we're going to wait for the market to shift bullish inside of this lower time frame because as of right now, we're inside of a bearish trend. So we're going to wait and play this out and see if we can kind of get any confirmation for any potential buys. Now, right here is our first sign, because what do we have here? We have the market sweeping a prior low and we're having a strong bullish impulse that breaks above this prior structural high. So now the lower time frame is showing us signs of bullishness, and we still have not hit that higher time frame objective. So we're going to look for potential buys now that the market has our two criteria on the lower time frame. We have a close above this prior high, and we have a fair value gap that is present. So now that we have our two criteria that validate this impulse swing, we are now going to look for the market to potentially hold this low. We're going to look for that retracement, and then we're going to start to look for the market to hold higher highs and higher lows to this first objective, and then potentially to this high. So let's go ahead and let's see exactly what happens in this scenario. So as we play this forward, we see that the market comes back down, and let's see if this overall swing is going to hold. So this is going to be our overall bullish leg. And again, if we want, you can put this right here below the 50%. You can get an entry at the 50%, stop loss below the low, and these are going to be objectives. But again, I'm just showing you guys the overall market structure. Now it's going to be validated if we can kind of close above this high, and this current candle doesn't. Let's see if this one does. And right there, we close above this overall swing. So now this is going to be our next low. And let's see if that's going to hold price until we get another closure above here. So right there, we hit our first objective inside this area. And this is exactly why I always tell people to make sure that you have this area mapped out, because sometimes you'll get some sort of retracement. But let's see if the market can ultimately head up to our higher high point and just kind of continue its overall bullish trend. We see the market still rejecting around here. And this is why it's so important to identify if there's any potential resistance, because from a trade basis, you could just take profits around here. But let's see if we're going to continue the overall bullish market structure, which now we're starting to get the expansion move higher. And as long as now this new low maintains, we're looking essentially for the market to do something like this to continue to the overall bullish side. So let's see what happens. And right there, the higher high is met. So this is the ultimate. Now this one was a little bit more of a choppy example, but the premise remains the same. As long as you understand swing points and market closures and your resistance levels, you have areas on the chart that you can map out in order to find consistent trades. Now let's go ahead and let's look at a bearish example. Now let's go over a bearish example. So here we have a clear swing high down to a swing low. So this is going to represent our higher time frame swing. So what we're going to do now is draw the swing high to low, and we're going to look for a potential confirmation down on the lower time frame at the 50% or above. Now again, remember, this impulse is validated because we're closed below that prior swing point, and we have a fair value gap that's present in here. So let's see if we can go down to the lower time frame, if we could find a lower time frame entry to match the higher time frame swing. So here we have our lower time frame, and we're going to wait for some sort of confirmation on this area in order to validate our potential short. Okay, so as of right now, the market is still inside of an overall bullish. Now, right here is the first sign of a bearish leg. The market has a swift move lower. We close below there. Now, let's see if we can get a fair value gap that forms. A fair value gap forms right there. So now this is going to be our validated swing. So we can then draw our swing high down to swing low. Can look for an entry around the 50% or above as an entry. Our stop will go above the high, and then we're going to look to target this area. Now we do have, again, a zone in here, which is going to be our first area of support in the event the market comes down into that area. And right there, the market has a little bit of reaction. We push up, but ultimately doesn't matter because the overall higher time frame trend breaches down to that low. Now, this is why it's so important to couple the higher time frame with the lower time frame, so you can find the exact turning point when the market is ready to make a lower high in this bearish example and a higher low in a bullish example. It gives you the best probabilities for the best entries once you have a clear higher time frame bias. Now again, you can incorporate this on any time frame. So even if you're someone who doesn't want to look at the higher time frame, you can incorporate this as a scalper using the H1 and M5/M1 confirmation. So now that we've successfully talked about identifying trends and breaking down our market structures, in next week's video, I'm going to be talking about how we can identify high probability reversals, and not only that, but how to identify when a trend is likely to be over. So make sure to subscribe, put notifications on, because next week's video at this same exact time, I'm going to be revealing how to identify high probability reversals with one of my top performing strategies. But in the meantime, if you want to check out other videos on this channel that's allowed me to get hundreds of thousands of dollars in payout, make sure to check out this video right here, as this will help you identify daily bias with over 80% accuracy.